So glad y'all could make it here. We got an awesome interview coming up with Jason Levine of Harry Levine. He's going to be telling us all the things you need to know in regard to multi-family insurance, best practices, and costly mistakes to avoid. Jason, give us a quick introduction.
Good morning, everybody. Jason Levine with Harry Levine Insurance here. I am a self-proclaimed insurance nerd. That includes having taught risk management insurance classes at Seminole State College. It includes holding a CPCU, which is Chartered Property and Casualty Underwriter designation. And because I am truly a serial academic and nerd, master's degree in risk management and insurance from Florida State University. So I have been at Harry Levine Insurance full-time since 2006, although as Joe pointed out once already, I kind of sort of grew up in the business. So whether I was playing on a 6-inch thick laptop in training mode on some insurance carrier's DOS-based software 30 years ago, or sitting here with Joe making social media content today, it's just in my blood. On that note, Harry Levine Insurance, the foundation of our agency dates back to the 1970s, right here in Central Florida in the Pine Castle area. As a matter of fact, 2 agents with Nationwide Insurance that were on opposite ends of Oak Ridge Road, those books of businesses were fused, and my family came over from the Tampa Bay area in 1996 to steward that, and we've just grown onward and upward since. In 2008, became independent agents, still representing and loving the Nationwide brands. Nationwide just made some distribution changes, and that was that, formalities. We're still loving them and loving the rest of the independent agent market force, which just enables us to do more things for our clients and our referral partners. So that's us in a nutshell, and can't wait for Joe to pick my brain and ask me some questions that hopefully don't stump me.
I hope not. Do you mind giving a quick, for the people who don't know, definitely not me for sure, what you just referred to, independent agents versus their, give a quick breakdown of that differential and the meanings of it for those who are outside the insurance lexicon.
Certainly. So in a nutshell, when you buy insurance, there are 3 different distribution channels, or let's make it real simple. You can go to 3 different stores. You can go to CVS, you can go to Walgreens, you can go to Rite Aid, right? So you've got direct writers, which that's an insurance company who's got a call center, and you call 1-800-INSURANCE and they quote you their product and their product only, and you can choose to buy from them. Then you have captive agents who are a contracted sales force that only work with one carrier. The typical models for that were Nationwide back in the day. That's no longer the case, primarily in the entire United States with them. State Farm is a captive agent. If you call a State Farm agent, you're going to get State Farm quotes. Allstate is typically a captive agent arrangement. If you call them, you're going to get Allstate quotes. If you call an independent agent, that's me, we're able to shop the whole market for you. A lot of people, think of the term broker, and there's a lot of at least functional accuracy to that. We'll keep away from the technical, but what we can do as independents is shop the whole market for you with an incredible set of carriers. Think Travelers, think Nationwide, think Hartford, think Auto Owners, think Progressive, et cetera, et cetera. Tons of national household brands, as well as the full gambit of the Florida domestic marketplace, which there's techno talk again. Companies based here in Florida that are a little bit smaller, perhaps you haven't heard of them. So 3 different stores you can go to. Direct writer, you're basically calling a 1-800 number and talking directly to an insurance company. Captive agent, you're walking into your neighborhood State Farm or Allstate type arrangement. Independent agent, you're walking into Harry Levine Insurance. My team or I are working with you to find you the best option from the whole expanse of the marketplace.
Okay. Wow. Well, there we go. I appreciate the quick breakdown, because I have had some conversations in regard to those differentials, and I appreciate the quick rundown.
Let me add one thing, Joe, and that is whether it's captive, a direct writer, and independent, no business, no person is quite like another, right? And when you're working with an independent, you need to do a little research and make sure that they have the ability to work with the type of carriers that will fill your needs. You know, a small independent might do a great job, but they might only have 3 or 4 relationships. A large independent might also do a great job, but they might have 30 or 40 carrier relationships, meaning carriers they do business with. So just know who you're calling when you call. Don't just Google or go back to the yellow pages like it's 30 years ago and think that all agents are created equal. We're not. Do a little homework, check out a website, check out Google reviews, and work with who you're comfortable with.
Is that how would you, if I was a brand new relationship with an insurance agent, would I just ask them will you give me a list of the carriers you do business, that you have relationships with, or how would I phrase that question?
I might ask, how long has your agency been in business? How long has it been under its current leadership? And, you know, what are your top insurance carriers that you work with? And that will give you a quick picture. If you're not hearing national brands, and we all work with you know, the smaller in-state marketplace because that's just nature of the beast in the state of Florida right now. But if you're not hearing longevity, if you're not hearing national brands that are household names, that might give you reason for pause. It might not. Again, everyone's got to start somewhere, right? And it's the age old, you know, you have to have experience to get a job as a server in a restaurant, but no one will give you a job as a server. So how do you ever get that experience? But you know, it's basically when you're forming that relationship, longevity, how many carrier relationships do you have? And do you recognize any of those names of those insurance companies?
That's interesting. One of the things that comes up, especially right now in Florida, is citizens versus, you know, market carriers. Will you give me because honestly, it's confusing to me because like when you use which one
Yep.
and why? Because
So,
some of the
Joe,
quotes I've seen from citizens seem to be significantly cheaper than market.
hmm,
Sometimes it's the inverse. And so anyway, and the requirements also vary greatly.
yep,
If you don't mind giving a rundown of that, I would appreciate it.
absolutely. So, first and foremost, Citizens is the state administered insurer of last resort. Real simple way to put that, it's kind of sort of the public option, and it should never, ever, ever be your first choice. Um, as a Jewish guy who likes ham and Swiss sandwiches, sorry, Citizens is Swiss cheese. If you analyze their coverage contract, their policy, it is so full of holes. And that's intentional. As a matter of fact, if you go to the leadership of Citizens, they will tell you that by design, remember I said it's the insurer of last resort, despite what some former governors who have sat in Congress and may or may not have tried to run for governor the last time around have espoused, and this is not a partisan issue, and that guy's been both parties and an independent, but Citizens is not a good tool. Citizens is, again, by design, by its own proclamation, insurer of last resort. That means bad coverage. It also, as far as the rating goes, is typically far below market, at least against, and we'll get into some technical terms again, the admitted market. And the reason for that is, as an insurer of last resort, darn near close to what a fair plan is in many other states, which is sort of like, I can't get insured, but you know, I have to participate in the economy. So there's this thing I can do. Citizens is rate controlled. So the legislature is actually who ultimately makes most of Citizens rules. So it's actually an act of Congress, so to speak, of the state legislature. And Citizens is capped in terms of the rate increases they can take per year, regardless of what actuarial science says. So regardless of what actuaries who do the math and say, if Citizens is going to be solvent, they need to charge this. They may need to take 60% rate. That's a real example from 2 years ago, but they can only take 10 to 15%. That creates a big problem, because what happens if '04 and '05 happen again? Charlie, Francis, Ivan, Gene, don't forget Katrina came across Florida as well. What happens? Well, Citizens can levy assessments up to 46% of your premium. So let's say you have, a large commercial building. I'm not talking about a 4 or 5 unit building now, but a large commercial building, and you've got $100,000 premium. They could turn around in a disaster scenario and send you a $46,000 bill. And a lot of people just go, I'm not going to pay it. Have you ever tried not paying money to the government? There will be consequences. And you will also find yourself likely non-renewed by Citizens, uninsurable then elsewhere, and still owing $46,000, or up to $46,000, up to 46%. So that's another danger of Citizens, is you are completely exposed to assessments. And some people might say, well, I can find assessments on my policy right now and I don't have Citizens. Correct. You have the Hurricane Catastrophe Fund charge and the FIGA, or FIGA, Florida Insurance Guarantee Association charge. Those are typically a fraction of a percent, or they hover around 1%. Citizens, again, can charge up to 46%. Now let's talk about, because you mentioned it, Joe, when Citizens can sometimes seem over market, particularly in the multi-unit sector. The excess and surplus lines market is used a lot in Florida now. The connotations of excess and surplus can seem negative. They're not. A lot of what we call E&S companies are actually much more healthily capitalized than some of the smaller, what we call admitted market or more heavily regulated companies. The excess and surplus line companies are absolutely regulated. They absolutely have to meet standards set forth by the Florida Office of Insurance Regulation. But for instance, they can charge whatever they want. So that's where you can see Citizens has these artificially low rates often. But if an E&S carrier really feels like they've got capacity, meaning they can write policies in a certain zip code or a certain county or some kind of niche, they can do that more aggressively. They do not have to file their rates and have them approved. The quote unquote admitted markets do. The excess and surplus lines market can look at you and I, Joe, and we could have all factors equal. We could own a building built in the same year of the same materials, the exact same blueprint, everything. And they could charge me price A and you price B. And it could be for whatever reason, including just when they wrote my policy, they only had 5 policies on the books and they felt they had a lot of capacity. When they wrote your policy, now they had 500 on the books and they felt that their capacity was dwindling and they didn't want to take on as much risk, or they wanted to charge more for that risk. It's actually a much freer marketplace and it can serve consumers really, really well. The big difference is, I mentioned the Florida Insurance Guarantee Association and the Catastrophe Fund. There is not required participation in either of those by those excess and surplus lines carriers. So there's not the catastrophe backstop. However, you often find that in the admitted market, you've got the Travelers, the Nationwide, that will not write multifamily units anymore. They also have ceded a lot of that business to some of those smaller companies that are they financially stable. So then you go over to the E&S side and you look at companies like Northfield that are owned by Travelers and have hundreds of millions, if not billions, in capital. Companies like Atlantic Casualty owned by auto owners. Companies like Scottsdale owned by Nationwide. So it's really those big players playing in this truly freer marketplace with hugely capitalized, highly solvent, excellent financial mechanisms, financial insurance companies, and they choose not to play on the admitted side because of the amount of regulation and the risk that if one of these $25 million companies goes out of business via their participation in the Florida Insurance Guarantee Association, they wind up having to pay that insurance company that went out of business's claims. So that's why they prefer to play on the other side, where there isn't that risk of the little guy going out and them having to foot the bill, which is what FIGA is all about.
Wow. Thank you. I appreciate the explanation. That's very helpful.
It's a lot of information and it's just, This could be a series of seminars.
We may have to do that. We have to do that. I would like to get, this is what every investor in multifamily wants to know. Their number one question: how do I save money on insurance? How do I get the best deal, not leaving one penny on the table?
Yep. Anymore, the answer to that is pride of ownership. I'm not an agent who's ever going to tell you, well, you could shave coverage here, you could shave coverage there. And our logic there is we like to function like a boutique agency, Joe. And what that means is we are not something for everyone, but people who really want to make sure they have proper protection while still being savvy within what is a very hard market. Let me go on a tangent for 1 second. Right now, 2023, we happen to be in what is referred to as a hard market. Basically, hard market equal scarce coverage, high prices. Soft market, plentiful coverage, lower prices. So we were in a soft market cycle for 20 years, basically from the dot-com bubble bust until about a year or two ago. It was generally a soft market. That cycle through the 20th century, the 1900s, was typically every 7 years. So we kind of got 20 years, 3 cycles worth of just soft. So it makes this hard market hurt even more. But when I say pride of ownership to save money, what carriers are looking for when they're underwriting right now are updates. Updates within the last 10 to 15 years. What's the condition of the roof, the plumbing, the wiring, the HVAC? So, typically when we look at a structure, there are 4 main systems. Very often we refer to a 4-point inspection. Again, that's roof, wiring, plumbing, HVAC. And if those things are updated, and that means, it doesn't mean a full replacement always. The roof, it generally does. But as long as they're in good condition, we've got inspections, they're up to code, that's the best way. Spend that dollar today to save a lot of dollars in years to come in those insurance premium costs. Also, talk to your agent. I would not advise you to contact 5 agents and say, I want all of you to shop the market for me. What'll happen there is a lot of everyone stepping on everyone's toes. There's also a concept of the market being blocked, which means if I go and I quote company A, and then the next agent down the street goes and tries to quote company A, that company is going to tell them, sorry, we've already received a submission or a quote request for that property. You weren't the first in. And a lot of times that's discouraging, particularly when you have, a half dozen agents, guys and gals, trying to work on this. So you really don't get the best attention, the best effort of the folks you're working with. Now, pardon me, should you call sometimes a second agent? Yes. That can be very, very powerful. Let's go back to our conversation a moment ago. A lot of us, there's a lot of overlap, right? Think of a Venn diagram. A lot of us have access to a lot of the same markets, but then there are a few that aren't in that common center area. So if you call me, I might have access to a program that the guy down the street doesn't, and he might have access to one that I don't. So there's value, I think, in engaging 2 agents. But once you get into 3 or more, you're getting too many cooks stirring the pot, and it's just not going to turn out well, in my experience. On the flip side, focus on relationship. That's another thing where you don't want to use one provider to keep the other provider honest, and both will figure that out quickly. And again, that won't bode well for the relationship. But I think it makes sense maybe every other year to involve a second opinion, and just make sure you have a good relationship with your agent.
If you are getting blocked out or locked out, which is something I am familiar with, and then as a investor who's looking to get a good price on insurance, it becomes very tricky, because how do you have any clue what the real price is? Because quote unquote, everyone's locked out from this other person.
Yep.
What is, like, if you're going to get shopped from 2 different agents to get competitive pricing, what is the correct process to do that so you don't like waste everybody's time either? I mean, we're not
Sure.
trying to just spin wheels for fun. You just want to know, hey, is this the best coverage I can get? So how
Yep.
would you select the two, and then how would you minimize the overlap of them calling the same carriers?
Yep. So selection is tricky. Again, I would lean into maybe what a Google reviews say. I would lean into a conversation where I ask, who do you represent? What are your main carriers that you work with and that you're going to ask, for quotes for me from? What kind of business do you place? You might find somebody who's really great at construction contractors and restaurants, and of course they might be a generalist. Of course they can look at your building, but how much of that type of business do they really write? And that may not even be an agency level thing. That may be an agent within the agency level thing. So it can be tough. But I think the questions to ask again are, how long have you been doing this? How much of this type of business, meaning your multifamily unit structure, do you write, or does your agency write? And who are the carriers you're going to go to? And if you're talking to multiple agents, if you know who they're going to shop your risk to, they're going to shop your building to, you can have a more constructive conversation, and you might decide, okay, this guy is going to look at these five, and this guy is going to look at these five. Although 10 active markets in 2023's marketplace, I guess I'm living in 19, well, maybe not 19, but 2019 at this point. But, maybe, we're most actively using these two or three, and this guy's most actively using these two or three. I think knowing who they're going to is critical. And we had an electrical contractor, large commercial electrical contractor, $5+ million in payroll, that worked primarily on airports and hospitals. So, and he every so often, every couple of years would shop, and we worked with him for 15 or 20 years. And he would do just that. He would say, give me a list. Who are you going to? And then he'd go to another agency, and he'd say, I'm getting quotes from these people. You stay away from them. I don't want to get into this mess. But if you have additional markets, if you have other qualified markets, shop it there. And that worked for him. It worked for us. We don't write the account anymore because it got to a point where it was Travelers at one point, non-renewed it. And we were in excess and surplus lines world. And excuse me, someone had a program that we didn't have access to. We have access to 95% of what's out there, but there is that missing 5%. Nobody's got 100%. If anyone tells you that, they're not being honest. And he found a program that suited his needs better when we got to that point. So I think, not to be too long-winded, but that's the answer. Know who they're shopping with. Don't just give them carte blanche authority.
No, I appreciate that. That's awesome. One of the things for me also, there's the other side of the coin. There's, as an investor, how do you make yourself and your properties as attractive to carriers as possible? Also, with the goal of obviously saving money on the premium, but it's like, how do you make you so that the carriers are like, ooh, that's a piece of business we want?
Yep. Fix things that go wrong, little things that may be nuisances. If you've got, obviously there's not a piece of cement in Florida that doesn't have a crack, but if you've got a sidewalk or a parking area where it's cracked and it's raised on one side, so you've got a trip and fall hazard, even if it's only half an inch or an inch, if you do get a policy written, this is on the general liability side now, you're probably going to get a recommendation from the carrier, which really means do this or we might cancel, to fix it. Be proactive with things like that. If you're in a situation where something's getting close to replacement, but you think you can milk another year out of it, just replace it. That's how you're going to make things the most attractive from an underwriting scenario. And remember, we're in a hard market. Scarce coverage, higher premiums. So when an underwriter is looking and they only have, X bit, pardon me again, of capacity, are they going to give it to someone that's demonstrating outwardly a little more pride of ownership, or someone who is kind of milking things along? The answer is pride of ownership.
Well, now we'll talk for a second about costly errors you've seen and how to avoid them, because obviously you don't want to make some big mistakes, especially if you can learn from someone else's mistakes before your own.
Yes. So I mentioned a moment ago about recommendations. So carriers will go out and inspect a building and they'll find, pardon me, I'm sorry, tree limbs too close to the roof, that cracked raised lip in a parking lot somewhere. Take care of the recommendations, please. What happens, the trap, is people don't, and then the carrier does have the right to take action, meaning cancel the policy. And then the investor, the property owner, they're mad at us, the agent. Understandably, we're the front line. Look, we're always going to be the whipping post, the whipping boy, whatever you want to say. But then we're going to have a challenge rewriting the business because every insurance application asks, have you been canceled or non-renewed in sometimes the last 3 years, sometimes the last 5 years? Now I have a fiduciary responsibility to say yes. And then I have to say why. So then I have to disclose all these problems. And by the way, the owner refused to comply and fix them. So now most carriers just go, okay, we'll pass. Some carriers go, show us proof of repair, now we'll take it. But that would be the biggest thing, is when you see recommendations, or again, when you see an issue, forget the carrier inspection pointed it out. Whether you've got a manager on site or you're going there periodically, it's the old, if you see something, say something. If you see something, do something. And that's where we are right now, is the condition of a property really has to be tip top when an underwriter is looking at it. Also, something that we're running into more and more. So talk to your agent about this, particularly when you're looking at a recommendations list or if an underwriter has an issue. They are relying more and more on Google Earth and Google Street View rather than a live human going out there. And don't get me started on society and tech right now. I love technology. I love what you and I are doing right now, Joe. But there's becoming a lazy reliance on it. And they may be looking at a photo that's 2 years old and that issue was fixed or that hazard is gone or whatever the case may be. So I guess another answer to a question you've asked several different ways, throughout the interview so far, is participate in the process. It may seem like a pain in the butt sometimes, and my agent's taking care of it. Your agent is taking care of it, but you need to be an active participant. Don't be passive. Because when little things like that come up and some underwriter sitting at a desk in Topeka, Kansas is looking at Google Earth and the image is from 2 or 3 years ago, that could make or break the availability of coverage to you. So ask them, hey, the rejections you got, what were the reasons, the underwriting rejections? Because an agent might, get responses from, let's say 10 markets, and they may show you one quote, but they probably got 2 or 3 quotes and they probably got 6 or 7 rejections. What was the basis of the rejections? Where are the other quotes? And sometimes there's not. In this market, sometimes there's just one option. Ask those questions and know that, though.
I've never thought to ask for the rejections.
Yeah.
That's
Why?
really
Why didn't they
interesting.
want it?
Is that something that most of the carriers give you? They give you some kind of response. Hey, we
Yep.
don't like it because of X. We don't like it because of Y.
Yes.
That is very worthwhile. I'm
It,
pretty
it
sure
can
that's a really
be
good idea.
it can be as simple as, we don't want to write with wind coverage in Orange County right now. It can be as simple as, we're closed in that zip code. We have too much risk there already. Or it could be, well, we were looking at Google Earth and we saw, a car on blocks in the back. Well, that car's not been there for 2 years. That's the kind of thing where, sometimes, more often than not, it just is what it is. But enough of the time, there's something there that, well, let's have a conversation about this. And in a hard market, again, where it can be so difficult to place coverage, you've got to be an active participant. 3, 4, 5 years ago, you really didn't, because there was just a plethora of capacity out there. Now that there's not, you kind of have to fight for yourself.
Thanks. I appreciate it. That's really good. All right. let's talk about how to look at like lender required coverage limits versus like the other version of it, I think, is
Oh
replacement
boy.
cost. Yeah, and like how you negotiate that or get the best coverage.
So this is kind of a never-ending tug of war. And there was there was a legal change 2, 3 years ago, which probably means 4 or 5 in my looking back capacity. But in Florida, a lender by insurance regulation, by code, cannot require you to insure for a loan amount. That is against regulation, unless the loan amount matches the actual replacement cost of the building. And the regulation goes on to state that the insurance agent and the mortgage officer can have license action taken against them by the state and fines levied if they willfully over-insure you. Now, don't try to play a game here. A lot of people do, and get the value of the building down. That's not what this is about. What this is about is if we use a computer model, also sometimes it can be acceptable to use a dollar per square foot method. But if we have a bona fide reconstruction cost of $1 million on a multi-family unit, and the loan on it is $1.7 million, and the bank is going, well, you need $1.7 million. That's a no-go. And typically what we found is we just kind of send them a very nice email citing the Florida statute that says you can't do this. And generally it goes away. That's not always the case. I have never lost a deal. I have never seen somebody not close and insurance not be bound because the mortgage dug in and said, well, you're going to insure for 1.7 in that example. So the issue there is having a open line of communication between you as the agent and the lender. And again, I would encourage the insured to be an active participant, the insured meaning the building owner, the person seeking coverage. But when you buy an insurance policy on property, you are not insuring the intrinsic value of the neighborhood, and you are not insuring the physical land. You are insuring the structure and likely appurtenant, if you've got a swimming pool on premises or a utility building or something like that, other structures. But again, the value of the, Beverly Hills zip code and the actual physical plot of land do not figure in, because you can't rebuild either. And insurance is intended to simply rebuild a structure back to how it was, at least in terms of property insurance, immediately prior to the loss. So I think, again, it's just open lines of communication and understanding that in Florida, thank goodness, finally, because it was tough for years. It has been codified that you must insure at replacement cost, and the value of a loan is completely by law irrelevant. And if somebody is forced to overinsure to meet a loan requirement only, not a reconstruction cost requirement, that is now against code in Florida, and there is administrative punitive action that can be taken by the either DBPR or the Department of Financial Services. That's who licenses us. I'm not entirely sure on the mortgage side, but license action and fines can be taken if they try to force you to do that.
Wow. That's good. And the replacement cost, is that something that you can, get a contractor to quote, or is it something that you just have to live with whatever the carrier chooses as their?
Yes and no. If you're an existing owner, you kind of just have to live with it, and your agent can advocate for you, and it's rarely out of hand. We've gotten used to very increased levels of per square foot cost over the last 18 months. But nonetheless, the yes and no part is if you're purchasing a building and you have an appraisal, the actual breakdown on the value of the building at that point of sale can be used. Again, intrinsic neighborhood value, actual plot of land value, irrelevant. But we absolutely can use an appraisal. Or what's used again, you can either use a per dollar per square foot method, which is less common. There's software programs. Marshall Swift and Beck MSB is one of them. There's another called 360, and they take average permit and construction labor and material costs in regions, and you plug in the details of the building, the square footage. Is it masonry? Is it fire resistive, meaning it's got steel beams and a flat roof, or is it joisted masonry with wood beams? And you put all those details in, and it spits out a cost, and that is sort of the industry standard, and you kind of have to live with it, but it can be massaged within reason. Is the building average construction? Is the building custom construction? Things like that.
Well, that's helpful. Some of our investors that we work with have policies specific for each property they own, and some have blanket policies covering multiple properties with even multiple ownership entities and different lenders on each property. I mean, obviously that seems like a give and take. How would you look at that, or what would you use to make that decision as which one's the better way to go?
I'm a big fan of one policy, one bill, but there's a big trap there, particularly on the liability side. And that is, I would always, always, always counsel, and it's typically somewhere between 5 and 10% additional charge, to add an endorsement such that each location has its own what's called aggregate liability limits. So what that means is you could have 20 locations on a policy, but if you have $1 million per occurrence, $2 million aggregate, that means up to 1 million per claim, up to 2 million per policy year. If you don't have the endorsement I just mentioned on there, and you have, two $1 million claims at location A, the rest of your 19 locations on that 20 location example, the insurance is exhausted and you're out of coverage for the year. With that endorsement on there, each location gets their own set of limits, their own million per claim, their own 2 million per year. And that's why it's that typically 5 to 10% charge, because the actual exposure to the insurance company is now 1 million per claim times 20, 2 million per policy year times 20. That's their maximum exposure. But what that does is make sure that, a bad occurrence at one property doesn't leave all of the others naked, so to speak, when it comes to liability protection. It gets a lot more complicated, though, in terms of how the ownership structure is. I would expect to see, if you've got 20 properties and each one is in its own corp or LLC, I would expect to see different policies. But if there's common ownership, go ahead, put it all on one. Logistically, it's easier for you. It's easier for, your insurance agent. You're probably going to have one effective date. It's a nightmare sometimes when, every time someone buys a building, they buy a separate policy, because you wind up with 20 different effective dates, 20 different bills, 20 different everything. When if you can add them to one, so to speak, master policy, it just keeps things organized and simple. But again, ownership matters. So you may wind up with a ton of different policies if everything's in its own LLC, which a lot of legal professionals will advise. And that is an issue. I'll stay in my lane. Talk to your business attorney about that. But if they're under common ownership, if you've got Joe's Properties LLC and that LLC owns 20 locations, put them on one and make sure you have per location aggregate limits.
That's useful. Is there any other things you feel it's important for the audience of multifamily investors to know about the insurance industry as a whole that you feel that they would benefit from?
In a nutshell, we're here to help you. We're here to take on risk. And I think a lot of people, and this isn't specific to multifamily investors, it's specific to insurance consumers at large. Insurance companies are bearing your risk. And it's very easy to get frustrated with premium increases and frustrated with, hey, you got to fix your parking lot, or you got to trim these trees. But you have to understand, you're paying a premium, you're paying a price for that insurance company to bear the brunt of all your risk. If you get sued, if you have, a fire loss, a hurricane loss, anything like that, it's now their problem. So understand, especially in market conditions like this, that when you're being underwritten, it's not personal. It's not about you. It's about what do materials cost? What are litigation costs right now? What is society doing, in terms of whether it's supply chain issues or whatever kind of thing could go wrong at your property? What's the real cost? You're paying to make that the insurance company's problem. So if you can kind of look at billing and coverage availability and so forth and so on through that lens, I think it just provides a degree of clarity. And also a lot of people, there's big premium increases right now. Look at your premium increase now. And if you've owned a building for 15 years, what was the premium 15 years ago? And now average those increases over all those years. It may not be as bad as you think. And remember, if the building, God forbid, burns down, if the building blows away, it's the insurance company's problem. And they're not going to fight a claim unless there's a reason to. There are a lot of mechanisms. Florida's a big consumer protection state. And look, just like any human organization, sometimes they get it wrong. That goes back to have a good relationship with your agent and employ them to advocate for you. If anything seems amiss in a claim, go to them immediately. And they have limited power, but we can advocate for you and speak with the carrier, speak with adjusters on sort of a different plane and really be an advocate for you.
That is awesome. Jason, thank you so much for taking time to share your decades of knowledge and your insurance nerdness full effect on display. I really appreciate it. Thank you so much.
My pleasure, Joe. Always good to chat.